Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing EMCOR stock by analyzing their financial statement and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 15 billion market cap. They're trading at $3.20 a share and they have 47 million shares outstanding. EMCOR is a leader in mechanical and electrical construction, as well as industry and energy infrastructure. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. Their free cash flow looks pretty good. It's positive every year, highest in 2023 at $820 million. Their margins were higher in 2020. They converted 9% of their revenue into free cash flow, 7% in 2023. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that grows a little bit each year from 130 million to 633 million. And their margins are improving. It went from 2% in 2020 to 5% in 2023. Net income margin is net income divided by revenue. It's what percent of your revenue you convert to net income. Revenue is the sales for the company, and that goes up each year from 8.8 billion to 12.5 billion. It grows in the low double digits year to year. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 13 billion. We discounted those numbers back to today's and weighted average cost of capital. We get a value of the company of $11.5 billion. We divide that by 47 million shares. And we get a calculated stock price at $245. They're trading at $320, so they're trading at a 31% premium. It's a sell according to the model. There are 39 companies in the same industry as EMCOR, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend too much on CapEx, 65 million. That's between the median and average. Quanta spends the most at 435 million. They don't use much debt. Their debt to equity ratio is 0.1. For every dollar of equity, they have 10 cents of debt. They pay a really small dividend, 0.2%. It looks like most companies in this industry have positive free cash flow. They rank third in market cap, half the market cap of number one. Price to book is stock price over book value per share. They're trading at 6 times book value. Their PE is better than the median and average, 23.8. That's stock price over earnings per share. And price to free cash flow also looks really good, better than the median and average. Their price to sales is equal to the median. They trade at a little more than 1 times revenue. And they generate a lot of revenue, 13 billion. Their 5-year annual revenue growth rate is a little less than the median at 9%. IES is number 1 at 21%. It looks like they've done 3 stock splits, a couple in 2006, and then a 2-for-1 in 2007. If you put $10,000 into this company 10 years ago, you'd be really happy at $73,000 today. That's a 22% annual return, 630% total return. Let's take a look at their 10K. We'll start off with their income statement, 2021, 2022, and 2023. So revenue does go up each year. Not that much, but it does go up. 12.6 billion in 2023. Let's see if they give a breakdown of the revenue. Of the 12.6 billion of revenue, 12.1 billion is in the US, 400 million in the UK. And they give a breakdown of the US revenue. 2.8 billion is US electrical construction and facility services. 5 billion is US mechanical construction. 3.1 billion building services, 1.2 billion industrial services. And all the UK revenue is building services. Let's go back to the income statement. Below revenue is cost of revenue. These are all the expenses directly tied to generating the revenue, 10.5 billion. So gross profit is revenue minus cost of revenue, 2.1 billion. It is up from last year of 1.6 billion. Their margins are improving. Gross profit margin is gross profit over revenue. It's the percent of revenue converted to gross profit. 2022 gross profit margin 14.5%, 2023 16.7%. They mentioned in 2023 acquisitions contributed to their gross profit. Approximately $15.9 million of their gross profit is directly tied to acquisitions. Below gross profit is SG&A, selling general and administrative expenses, $1.2 billion. Their G&A is up as a percent of revenue. Last year was 9.4%. This most recent year is 9.6%. They mentioned here the increase in SG&A was mainly attributable to increases in incentive compensation expense across the majority of our reportable segments. That's stock-based compensation. They do have positive operating income, $875 million. Their operating margin improved a lot. It was 5.1% last year, 7% this year. Their net income is $632 million, up more than 50% from last year. Last year, $400 million. So their EPS, $13.37 compared to $8.13. And they're paying dividends, 69 cents per share, up from 54 cents. So it's a pretty big jump. Let's take a look at the balance sheet. Current assets of $4.4 billion, current liabilities of $3.5 billion. So they have a current ratio above 1. They have $800 million of cash, $3.2 billion of accounts receivables. Accounts receivables is how much money other companies owe them when they sell on credit. A lot of goodwill, almost $1 billion of goodwill. Here's a breakdown of the goodwill. $178 million of the goodwill is acquisitions from U.S. electrical construction companies. $318 million is from U.S. mechanical construction companies. $346 million is U.S. building companies. And $114 million industrial companies. Total assets increased from $5.5 billion to $6.6 billion. Liabilities $4.1 billion, up from $3.6 billion. Their biggest liability is contract liabilities, $1.6 billion. They give a breakdown of the contract liabilities. $400 million electrical construction, $900 million mechanical construction, $220 million building services. Let's take a look at their equity. Assets minus liabilities equals equity. They have $2.5 billion of equity. They're really profitable. Retained earnings of $3.8 billion. That's how much money they've made from running their business. It's a sum of all their prior net incomes minus the sum of the dividends they paid out. And they buy back lots of stock, $1.4 billion. Treasury stock is a contra equity account. It brings down your equity balance. Let's take a look at the statement of cash flows. The first section is operating cash flow, $900 million of operating cash flow. That's net income. Then you add back the non-cash items on the income statement, $52 million of depreciation, $67 million of amortization. Then we have to adjust for changes in working capital. It looks like they extended a lot of credit. $626 million of accounts receivables. This will result in cash inflows in future accounting periods. It looks like a lot of that dollar amount is offset by contract liabilities, nearly $500 million of cash inflow. In their investing section, they spent $96 million of cash in acquisitions and $78 million from PP&E, property, plant, and equipment. The third section on the statement of cash flows is the financing section. They had a cash outflow of $400 million. It looks like they paid down $246 million of long-term debt, and they bought back $127 million of their own stock. Last year, they bought back $660 million of their own stock. Let's look at the company on Simply Wall Street. Its last price, $326, $15 billion market cap, up 7% in the past week, up 94% in the past year. Let's see what they say about the company. EMCOR Group provides construction and facilities, building, and individual services in the US and the UK. They offer design, integration, installation, startup, operation, and maintenance services related to power transmission, distribution, and generation systems. Energy solutions, electrical and lighting systems, process instrumentation, low voltage systems, voice and data communication systems, roadway and transit lighting, signaling, and fiber optic lines. They also offer computerized traffic control systems and signal and communication equipment, heating, ventilation, air conditioning, refrigeration, and geothermal solutions, clean room process ventilation systems, fire protection and suppression systems, plumbing, process and high purity piping systems, controls and filtration systems, water and wastewater treatment systems, central plant heating and cooling systems, crane and rigging services, millwright services, and steel fabrication, erection, and welding services. They also provide building services that cover commercial and government site operations and maintenance, facility management, maintenance and services, energy efficiency retrofit services, military base operations support services, services for indoor air quality, floor care and janitorial services, landscaping, lot sweeping, and snow removal services, vendor management and call center services, installation and support for building systems, program development, management and maintenance for energy systems, technical consulting and diagnostic services, infrastructure and building projects, modification and retrofit projects, and other building services including reception, security, and catering services. In addition, it offers refinery turnaround planning and engineering, welding, overhaul and maintenance, instrumentation and electrical, as well as renewable energy services. They were incorporated in 1987, headquartered in Norwalk, Connecticut. Here's the stock price since 1995. It's hard to tell on this chart. Let's look at 5 years. It did come down in March 2020 from COVID, $51. But look how much it's been growing lately. It's well over 300 now. I wish I knew about this stock. I just heard about it recently. Simply Wall Street's valuation is $416. They say the stock is 22% undervalued. 2 analysts priced this stock at $305. They say it's overvalued. Here's their revenue forecast for the next few years. Revenue for 2026 close to $16 billion. The free cash flow forecast is almost $800 million by 2026. They don't keep much debt on their balance sheet. The highest was a little over $500 million. This blue line is their equity, which is a lot higher than their debt. Currently, they have no debt. They're all equity, $2.5 billion of equity. And this green line is their cash, which is usually higher than their debt. Here's their dividend yield since 2014. It was 0.7% back then, but the stock has been coming up so much, the yield has been going down. It's currently about 0.3%. The forecast is 0.2% by 2025. The CEO's salary is a little over $1 million. $11 million total compensation, tenure as CEO over 19 years. A couple insider sells in the past 12 months, no buys. 93% of the company is held by institutions, 5% by the general public, and 1% by insiders. The biggest shareholder is BlackRock at 11%, Vanguard at 10%. Kane Anderson is a Los Angeles investment firm, over 7%, then Fidelity, State Street, Fuller. You have Morgan Stanley, Wells Fargo, Invesco, Northern Trust, Schwab, Eaton Vance. Their employee count has gone up, 27,000 in 2013, 38,000 currently. And the ticker trades on the New York Stock Exchange and Deutsche Börse. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.